Hello everyone, my name is Joshua Aura. I teach group accounting or consolidation at Aaro Academy. Our vision as Aaro Academy is to be the best practical accounting and IFRS training institution in the world. Ladies and gentlemen, today I would want us to go through IFRS 10. IFRS 10 is the consolidated financial statements. Overview. Specifically, IFRS 10 requires a parent entity that has subsidiaries to prepare consolidated financial statements, what we also call the group accounts. It defines the principle of control, the investment entity. It also sets out the accounting requirements for the preparation of consolidated financial statements, besides what here, the exceptions. Control as a basis for consolidation. Ladies and gentlemen, the basic rule is, if an investor controls its investee, then the investor must consolidate. If an investor does not control its investee, then the investor does not consolidate. Control as a basis for consolidation. An investor is said to control an investee when the investor is exposed to or has a right to variable returns from its involvement with its investors. Ladies and gentlemen, a good example here is dividends. You know, dividends can never be constant. Dividends will be varying, of course, depending on the performance of a company. So we are repeating again that we will be said to be in control of an investee as a parent company if we are exposed to or if we have a right to variable returns from our involvement with our investee company. And then number two, the company has the ability to affect those returns through its power over the investee. Illustration for us to understand this concept of control. Remember the old standard used to look at control from the perspective of shareholding. It used to tell us that provided you've got over 50% of the shares of a company, then that company becomes your subsidiary. That is not what the new IFRS 10 tells us. And for us to be able to understand control from the perspective of IFRS 10, let's look at this illustration. We are told Sophistic company has 10,000 shares of $1 each. On 1st January 2020, Pedantic company acquired 4,500. Pedantic company acquired 4,500 of these shares. Ladies and gentlemen, basically, Pedantic has acquired 4,500 out of 10,000. That is 45% shareholding in company Sophistic. So somebody would argue that 45% is less than 50% in significant what here? Shareholding. So somebody would argue that there is no way Sophistic can be a subsidiary of Pedantic. Let's continue. We are told in addition to that shareholding, Pedantic company is able to appoint 3 out of the 5 directors of Sophistic company. 3 out of 5. Ladies and gentlemen, that means what here? Control. Because remember, the work of directors of a company is to make decisions. So here it means that Pedantic is powerful. It is putting more decision makers of Sophistic in their board. So we are reading this again. In addition, Pedantic company is able to appoint 3 out of the 5 directors of Sophistic company. Thus, exercising control over their activities. How should sophistic company be treated in the consolidated financial statements of pedantic company? Now listen, we are told there, pedantic holds 45%. How do you get the 45%? 4,500 over 10,000 times 100. 45% of sophistic's ordinary shares, which is less than 50% that we discussed. Nevertheless, sophistic is a subsidiary of pedantic because its status is determined by a number of factors other than the percentage of shares held. The key point here is control rather than share ownership. And for us to understand this, look at this note on control. We are told a company will be treated as a subsidiary if any of the following applies. A, it holds more than a half of the voting power. Number two, it has power over more than half of the voting rights by virtue of an agreement with the other investors. So you could be having, for example, 20% of the shares. You could be having, for example, 20% of shares of a company. But if the other investors have bestowed on you more than a half of the voting rights in whatever capacity, then automatically you have the power of controlling that company. We are told in 3 there, it has the power to govern the financial and operating policies of the entity under a statute or agreement. D, it has power to appoint or remove the majority of the members of the board of directors. 5, it has power to cast majority of votes at meetings of the board of directors. In our sophistic's case above, sophistic's case above was treated as a subsidiary on the grounds that pedantic is able to appoint 3 out of the 5 directors, which is criterion D. Ladies and gentlemen, consolidation procedures. Now that we have been able to identify our subsidiary, that company that we have control over, IFRS 10 requires us to consolidate, to put together the financial statements of the parent vis-a-vis the financial statements of what here? The subsidiary. We put them together. So as we do that, we must combine like items. If it is PPE of the parent, property, plant, and equipment of the parent must be added to property, plant, and equipment of what here? The subsidiary. The same case to sales. The same case to liabilities, assets, etc. Ladies and gentlemen, offsetting is the major thing. If there are any internal arrangements, internal investments, like now when we invest in this subsidiary, according to IFRS 10, any intragroup items must always be eliminated, Ladies and gentlemen, this is a very important procedure of consolidation that we need to appreciate. Now we go to an illustration. Illustration, we are told, 2 years ago, pedantic paid $90,000 for a controlling interest of 80% in sophistic's equity when retained earnings were $25,000. The summarized statement of financial positions at reporting date are given there. We have investment in sophistic. Pedantic, 90,000. That has to be booked. Remember at Aaro Academy, we are teaching you practical group accounting. We want to give you competencies. We want to give you skills which you will simply make use of once you land on a job as a group accountant. And that is why you need to spread this word. across to all your friends globally, about Aaro Academy. So we have property, plant, and equipment. You can see pedantic, 30,000, sophistic, 28,000. And then the current assets have been provided there. We have equity shares. We have retained earnings. Continued on the other page. We have liabilities, 25,000, 5,000. Additional information that you have been able to come up with as a group accountant. We are told at the date of acquisition, the fair value of the NCI of Sophistic was measured at $20,000. We are told for consolidation purposes, at the date of acquisition, the fair value of an item of plant of Sophistic exceeded its carrying value by $25,000. Sophistic has not incorporated this fair value adjustment into its individual financial statements. The item had a remaining life of 5 years. At the reporting date of pedantic, pedantic is owed $5,000 by Sophistic. Goodwill impaired is 1,000. And then we are required here to prepare pedantic's group statement of financial position. So the group's statement of financial position. Now, ladies and gentlemen, listen. So what I will do is to show you how we do our analysis manually, right on the board, just like your classroom teacher used to write. And then after this, I'll also have a session with you where I'll show you how to capture these group entries in Excel. And then later on, I'll be bringing on board a consultant who understands the Aaro group accounting software, to come and input the same figures to our software, which will be able, ladies and gentlemen, to provide the same answers like what we shall be getting. So 3 ways. Number 1, I'll do it manually. Number 2, in terms of computerization, I'll capture the same workings on Excel, and then we shall capture these workings, rather prepare these group financial statements, using the Aaro software. Aaro software is a superior software of consolidation. You will have very big brands in Kenya and indeed globally using Aaro to consolidate financial statements. Now here we are. When we talk of consolidated statement of financial position, a good group accountant will always think of the 5 basic steps, basic workings, which are needed before you start consolidating. The 5 steps. Number 1, come up with a group structure. So we have here the group structure. So we have here the group structure. So we have the group structure. So this is working number 1. Group structure is working number 1. So group structure, I would want to share this with us. So we are told here, 2 years ago, Pedantic paid 90,000 for a controlling interest of what percentage? 80%. So ladies and gentlemen, we have a company here called Pedantic, which acquired some stake in Sophistic. Quite a huge stake, which is what here? 80%. Ladies and gentlemen, of course, 80% is a serious what here? Shareholding. Is a serious shareholding. It's more than 50. It's more than 50. That automatically makes this company or rather this company here, to be called what here? Our subsidiary. And if it is called our subsidiary, you can see we don't own everything. We don't own everything of Sophistic. So the other smaller percentage is owned by a team we shall be calling NCI. NCI will be owning 20%. NCI stands for the non-controlling interest. That percentage is smaller. Non-controlling interest. Now, ladies and gentlemen, that is working number one. Very important working. You must always appreciate the group structure. Group structure. And the group structure, get the group's percentage and the NCI's what year percentage. These percentages will really guide us as we get along. Great. Now, ladies and gentlemen, the next thing that I would want us to appreciate here, next working, is the working of the net assets of the subsidiary. So we have here net assets of the subsidiary. So we have net assets of the subsidiary, as measured by its equity elements. So then, ladies and gentlemen, what we have? We'll have to account for net assets of this subsidiary at acquisition. And then the same subsidiaries net assets at reporting. Very important. Very important. Now, ladies and gentlemen, please go to the equity section of this particular illustration. You can see under equity, the financed element, under equity, we have shares. So start by giving us the equity shares. So we have here equity shares, remember, of the subsidiary. Ordinary shares of the subsidiary is Sophistic. You can see here, ladies and gentlemen, you can see here the equity shares of the subsidiary called Sophistic. They are worth 15,000. So we have here 15,000. Now listen, there is nothing like new shares which were issued by this subsidiary. So ordinary shares will be the same for the period, the time of acquisition and the time of what year reporting. So the ordinary shares, of course, there are no changes in terms of our share capital in between here. So 15,000 will be the same figure to be written here at reporting dollars. Ladies and gentlemen, we also have something very important under equity here. As you can see, we have the retained what? Retained earnings. I'm not interested in the retained earnings of the parent Pedantic. I'm interested in the retained earnings of Sophistic. And you can see at the date of reporting, remember these financial statements are given at the date of reporting. At the date of reporting, Sophistic, which is our subsidiary, had retained earnings of 40,000. Retained earnings of 40,000. This is very, very important for me. Ladies and gentlemen, we have here retained earnings. We are saying at the date of reporting. At the date of reporting, at the date of reporting, at the date of our statement of financial position, we had retained earnings of 40,000. Retained earnings of the subsidiary were 40 at reporting, 40,000. How about retained earnings at acquisition? So you have to check through your records and ascertain the retained earnings of the subsidiary at acquisition. The retained earnings of the subsidiary at acquisition. So at acquisition, retained earnings of the subsidiary, we are told here. 2 years ago, Pedantic paid $90,000 for a controlling interest of 80% in Sophistic's equity when the retained earnings were 25,000. So retained earnings, ladies and gentlemen, at acquisition date of the subsidiary was 25,000. And that is why, ladies and gentlemen, you need to engage an expert, especially whenever you are making acquisitions even for purposes of record keeping, right? You'll get, in this case here, people will not be able to capture information from the word go as they do these acquisitions. So legally, ensure that you have experts, work with experts. Like when you work with Aaro systems, you can't go wrong. And then of course, when you have all your employees, group accountants, being trained by Aaro Academy, again, you will get your group consolidation right. You'll get your group consolidation right. You can't go wrong. So here we are, retained earnings at acquisition 25,000. Now, ladies and gentlemen, the other aspect which must go to our net assets of the subsidiary, of course, during, ladies and gentlemen, during acquisitions, it will always be important for us to look for fair values of the subsidiary's assets. Fair values of the subsidiary's assets. So we are told here, there is a very important statement, which tells us, that at the date of acquisition, the fair value of NCI of Sophistic was measured at 20,000, not NCI. We are looking at net assets of what year? Of the subsidiary. Note number 2. For consolidation purposes, at the date of acquisition, the fair value of an item of plant of Sophistic exceeded its carrying value by $25,000. Ladies and gentlemen, listen. We are saying that we had a fair value adjustment. Fair value adjustment of how much? Fair value adjustment where the fair value was higher of this plant was higher than the carrying value by 25,000. So our assets value went up basically. So the fair value adjustment at the date of acquisition was 25,000. If you remember, even in your theory, this fair value adjustment does not change. We shall have the same fair value adjustment reflected at the date of reporting, because really in between here, you can't keep on revaluing assets that first. So we have here fair value adjustment at acquisition, 25,000. And of course, at the date of reporting, the fair value adjustment will still be 25,000. Now remember, if it's a depreciable item, it will be very important for us to come and capture the depreciation of the fair value adjustment. Because remember, this fair value adjustment, chances are you're even told in this question, that Sophistic had not incorporated this fair value adjustment. So of course, if they are not incorporated the fair value adjustment, it goes without saying that even its depreciation had not been factored in. So what have they told us which can help us to ascertain depreciation? Number 1, the item has a remaining life for 5 years. So meaning what? Ladies and gentlemen, listen here. Listen. What do we have? We have depreciation per annum. It will be this fair value adjustment of 25,000 divided by 5 years. That gives me depreciation per annum because there is no residual value. So straight line method will be 25,000 divided by 5, which gives me depreciation of this fair value adjustment per annum. But how many years have we stayed with this subsidiary? Ladies and gentlemen, remember, since acquisition, 2 years have lapsed. Since acquisition, 2 years have lapsed. Since acquisition, we are told here 2 years ago, pedantic paid. So times 2. So then this will be 25,000 divided by 5 is 5,000. 5,000 times 2 is 10,000. So depreciation of this fair value adjustment can only be booked here. Fair value adjustment can only be booked there. Remember, depreciation is a time-based adjustment. So for the 2 years, we've stayed with this subsidiary. This assets cumulative depreciation is 10,000, we book it there. There is nothing really more. What we need to do is to come and ascertain now the total net assets as at reporting date and as at what? Acquisition date. So please get your calculator, and then you ascertain these figures. So using your calculator, what do we have? Using our calculator, ladies and gentlemen, this is what we shall be having. So we have here 15 plus 25 plus 25 again, which gives me 65 here. The total net assets at acquisition will be 65,000. How about total net assets at reporting date? We have 15 plus 40 plus 25 minus 10, which gives me 70,000. Now listen and listen to me very well. Net assets at acquisition will help us later on in computations of goodwill. Net assets at acquisition will help me. Net assets at acquisition will help me in computations of what we call goodwill, later, goodwill. But most importantly, as of now, we are saying this one here will help us compute goodwill. Most importantly, as of now, ladies and gentlemen, is to ascertain. Most importantly, will be to ascertain our post-acquisition. Come and ascertain our post-acquisition, ascertain our post-acquisition profits. So post-acquisition, ladies and gentlemen, how did our subsidiary perform? So to get post-acquisition profits, ladies and gentlemen, what you do, you take the net assets at reporting minus net assets at acquisition. So anytime they want you to ascertain post-acquisition profit, what have I said? You will come and work with the net assets at reporting, which are what? 70,000 minus net assets at acquisition. So you can see our net assets grew because of the profitability. Grew by how much here, somebody? 5,000. Net assets at reporting minus net assets at acquisition gives us what we call post-acquisition. Ladies and gentlemen, the moment we have this post-acquisition profit, what are we supposed to be thinking about? Once we have, ladies and gentlemen, this post-acquisition profit, remember, it has to be shared to the two parties. We have two parties running. We have two parties here running this entity. We have the group, because it has got control, and then we have what we call NCI. So these has to be split into two. Remember the group structure, the group had what here, 80%. So 80% of 5,000, 80% of 5,000, 80% of 5,000 will give me 4,000 bob. So the group retained earnings will increase by that 4,000. The NCI is 20%. So 20% of 5,000 will give me what here? 1,000. So the NCI will grow by 1,000 bob. The two must add up to the 5,000. So that is working number 2. Net assets at acquisition, net assets at reporting, which at the end of the day should be able to give us the post-acquisition profits. Now, ladies and gentlemen, the moment I do that, listen. The third working, listen. The third working will be a working or called goodwill. So come and give us the goodwill. Give us the goodwill. Come and give us goodwill. 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 So goodwill, ladies and gentlemen, goodwill is quite an easy thing to compute. What we shall do is to look at the considerations paid. The considerations paid. We have two stakeholders here. We have the parent company. The parent company must have paid something to acquire its stake in Sophistic, to acquire its stake in the subsidiary. What are we told about? What are we told about this parent company? What we are told about the parent company, ladies and gentlemen, is that Pedantic paid how much? 90,000. 90,000. So we have here 90,000. And then, ladies and gentlemen, the other consideration was paid by NCI. NCI, we have the fair value of NCI. There must have been some valuation done. So the fair value of NCI, what are we told about the fair value of NCI? We are told here at the date of acquisition, the fair value of NCI was 20,000. So we have fair value of NCI. We have fair value of NCI. Fair value of NCI is 20,000. Now from there, you'll come under less net assets at the beginning, net assets at acquisition, net assets at acquisition. Net assets at acquisition, if you can remember our net assets table, we had a net assets at acquisition figure of 65,000. So you subtract this. So we paid in total 110, but we got assets worth 65,000. That premium over and above excess is what we call the goodwill. So come and give us the goodwill, on acquisition. Goodwill on acquisition. So goodwill on acquisition, what do we have here? So if you have your calculator, you should be able to give us this goodwill on acquisition. So this will be 90,000 plus 20,000 minus 65,000, which will end up, ladies and gentlemen, giving us 45,000. This will end up giving us 45,000. So this 45,000 is goodwill on acquisition. Goodwill is an asset. Just like any other asset, we expect its value to reduce with time. Reduction of goodwill's value is what we shall be referring to as impairment. So we need to come and capture the impairment. We need to come and capture the impairment. The impairment of goodwill, this information has been given here. This information has been given in note number 4. Goodwill impaired is $1,000. Goodwill impaired is $1,000. So goodwill impaired, impairment is 1,000 here. So 45,000 minus 1,000, this gives us 44,000 like that. So this is goodwill. This is goodwill at reporting. This is what will go to our group's statement of financial position. Goodwill at reporting is 44,000. So this is very important for me. Very important for me. After goodwill, ladies and gentlemen, the next thing that I will do is to come and capture a working for NCI. Please capture a working for NCI. So come and capture a working for NCI. And NCI is quite a simple thing to ascertain. NCI is quite a simple thing to ascertain. The NCI is quite a simple thing to ascertain here. NCI is quite a simple thing to ascertain. So give us here NCI. So for NCI, what do we have? We have NCI at the beginning, NCI at acquisition. NCI at acquisition, ladies and gentlemen, we were given a figure. We were given the evaluation. We were told, if you can remember, we were told at the date of acquisition, NCI was worth 20,000. Now, ladies and gentlemen, we know that NCI's value grew with time. Grew with time because of what here? The post-acquisition profit. So come and add NCI's share of post-acquisition profit. So post-acquisition profit, what do we have? I can remember the 5,000 figure. We said the group will take 4,000. We said NCI 1,000. So I'm adding this because it's a profit, 1,000. Ladies and gentlemen, because we used full goodwill approach, which I'll be showing you later what it means, we must come and deduct. We less NCI's share of goodwill impaired, of goodwill impaired, goodwill impaired, of goodwill impaired. Remember, there was an impairment loss of goodwill. Impairment loss of goodwill of 1,000, of 1,000. Our share as NCI is only 20% of that 1,000, which will come and give me here 200. So please come and deduct this. So we have 20,000, 21,000 minus 200. This gives us 20 what here? 800, like that. 20,800, like that. So that is very important for me. Very important for me. NCI. NCI. I called it full goodwill simply because you captured both considerations in your computation of what here? Goodwill. You captured the consideration of the parent company, and as well, you captured the fair value of NCI. Of NCI. When you capture those two values, while computing your goodwill, the impairment loss has to be shared between the two parties. Otherwise, if you only took the fair value of the parent and then you left out the fair value of NCI, then that would have been what we call the partial goodwill computation approach. And the partial, you don't apportion the goodwill impaired. You only take the entire amount of goodwill impaired to the group's retained earnings. Thank you. Now from there, we move on to the next level. So the next level, which happens to be the fifth working, which is our last working, ladies and gentlemen, is what we call the group. The group's retained what here? Retained earnings. Group's retained earnings. So group's retained earnings is very easy. For group retained earnings, come and give us the parents retained earnings at reporting. The parents retained earnings at reporting. The parents retained earnings at reporting. Go to your reports. Your reports. In your reports here, you'll be able to see retained earnings. Retained earnings of which company? Of Pedantic, which is a parent. You can see retained earnings there. We had 100,000. At reporting date, 100,000. Ladies and gentlemen, after you have done that, come and give us our share. So add in this case here, the group share. The group share of the post-acquisition. Of the post-acquisition profits. Group share of the post-acquisition profits. So if you remember our profitability, post-acquisition profitability, we said it was 5,000. 5,000, the group shareholding percentage is 80%. So then when you take 5,000 times 80%, you'll be able to get 4,000. And then don't forget to less the goodwill, the group's goodwill impaired. The group's goodwill impaired. It's a loss. It's a loss. So remember, we had 1,000. This 1,000, our share is 80%. For this 1,000, our share is 80%. So 80% of 1,000 is 800. So please do me a favor, come and give us the group share, the group's or rather retained earnings at reporting. At reporting. What do we have here? We have 100,000. 100,000 plus 4,000 minus 800, which gives me 103,200. So 103,200. This is the figure that I will be taking, ladies and gentlemen, as my figure in the consolidated statement of financial position is the figure that I will be taking here as my retained earnings at reporting, and that is it. So NCI at reporting, this is the figure I will take. I remember goodwill at reporting, this is the figure I will take. So that is it. So come and give us, ladies and gentlemen, our pedantic group. So we have here pedantic group, statement of financial what year position, financial position, statement of financial position. Of course, they haven't given us a date, right? So we start with our consolidation process, which now should be a straightforward thing because we have everything. So we start with the non-current assets. So non-current assets. So for the non-current assets, ladies and gentlemen, what we have, listen. For the non-current assets, ladies and gentlemen, the first one, remember I'm following this approach. They have told me investment in sophistic. So investment in sophistic, this should be canceled out. Why? Because there is no way I can claim that I've invested in my subsidiary, something that I've got control over. Basically, that is like moving money from point A to point B. So this investment in sophistic is an intra-group item. It's an internal investment. So this will be eliminated automatically. However, remember when you are investing in the group, you paid some premium. That premium that we called goodwill is what will replace this line. So now we have here goodwill. And the goodwill on reporting, what do we have as our goodwill on reporting? Goodwill on reporting, if you can remember, goodwill on reporting, what we have here is 44,000. So goodwill on reporting is 44,000. From there, ladies and gentlemen, the other non-current asset that we have, is here. The other non-current asset that we have is property, plant, and equipment. So we have here property, plant, and equipment. So remember, we are consolidating. Consolidation is all about putting figures together. So property, plant, and equipment of pedantic is 30,000. 30,000. So this is 30,000 plus we have the one of what here? We have the one of sophistic, PPE of sophistic, plus 28,000. But now remember that we had some fair value adjustment. The fair value adjustment increase was 25,000. This has to be added here, and it never went without the extra depreciation. So come and subtract the depreciation on the fair value adjustment. Come and subtract the depreciation on the fair value adjustment. If you remember this, in the net assets, we had obtained it as 10,000. We had obtained this as 10,000. So come and give us, ladies and gentlemen, come and give us this particular total consolidated property, plant, and equipment figure. So what do we have? We have 30,000. We have plus 28,000. We have plus 25,000. We have minus 10,000. Minus 10,000, which will give me 73,000. 73,000. So we have here 73,000. From there, ladies and gentlemen, come and give us the current assets. The current assets, have they given me classes like inventory, etc.? Let me check the question. So the current assets, ladies and gentlemen, that I can see, they have given this to me as a block. So no problem. I'll come and talk of current assets. We have 30,000 plus, ladies and gentlemen, we have 32,000. So here we need to check whether we have any intra-group receivable. Do we have any receivable that we expect to receive from any member of the group? Yes, we do. Ladies and gentlemen, we do. They have told us here, the current assets, they have told us that at the reporting date, this is note number 3, at the reporting date, pedantic is owed 5,000 by sophistic. So pedantic has booked a fake receivable. That's a fake receivable. A receivable within the group. can never be genuine. Remember, our assets and liabilities which are genuine are the ones in this case that have connectivity with external sources. But anything that we expect to be paid internally, that has to be eliminated. So that intra-group receivable or pedantic, that has to be eliminated in the current assets because receivable is a current asset. So come and tell us minus 5,000. So then what do we have here at the end of the day? So at the end of the day, ladies and gentlemen, what we have at the end of the day here will be 30,000. 30,000 plus 32,000 minus 5,000. Minus 5,000, I'm able to see 57,000 here. Current assets, 57,000. So please come and add. You give us the total assets. Add here for you to get the total assets. So we have plus 73,000 plus 44,000. What do we have? We have 174,000. So here we have 174,000. So from there, we look at how these assets have been financed. Equity versus what here? Liabilities. So we begin with equity. We begin with equity. So equity, ladies and gentlemen, what do we have? We have the ordinary share capital. Remember, for the share capital, we normally take the share capital of the parent only. When consolidating, we take the share capital of the parent only. Reason being, the share capital that the subsidiary has, who owns it? It is the parent company. It is a parent company which has got control. So there is that concept of what here? Elimination. The most important thing for your practicality is for you to understand that whenever it comes to consolidated equity, we only take the share capital of the parent. For share capital, it's for the parent only. So for the parent only, what we have here, ladies and gentlemen, what we happen to be having for the parent only, equity shares, we have a figure of 25,000 here, a figure of 25,000 there, a figure of 25,000 there. Now, ladies and gentlemen, we have retained earnings. It's a component of equity. Unfortunately, for retained earnings, we have a figure for the group's retained earnings of 103,200. 103,200. Now, apart from that, remember, we are not running this business alone. We are not running this business alone. We have some partners in the name of what here? NCI. So we have some partners in the name of NCI. So because they are not coming to take their monies in the near future, let's book that as part of their capital, as part of a capital year. So the NCI at reporting, already we have a figure of 2,800. 2,800. Now, the only thing that you need to do is to come and capture liabilities. Liabilities, we begin with non-current. We begin with non-current. And when you check our illustration, we don't have liabilities being classified. We simply have liabilities. So come and consolidate them. So these liabilities, what do we have? We have 25,000 plus 5,000 plus 5,000. Now remember, listen. Ladies and gentlemen, when we spoke of intra-receivable, pedantic, we were told here pedantic had a receivable from sophistic. We are told here that pedantic is owed 5,000 by sophistic. So pedantic recognizes in their books this as a receivable, and the sophistic in their books, they are recognizing that as a payable. So it's an intra-payable, an internal payable. So if it's an internal payable, you must also come and remove it from here. So minus 5,000, which at the end of the day then will give me 25,000. So please come and give me here the total equity and liabilities. The total equity, come and give me the total equity and what here? Liabilities. Give me the total equity and liabilities. So please get your calculator. You have 25,000 plus 103,200, 103,200 plus 2,800 plus 25,000 giving me 174,000, which agrees with this particular figure that we have here. Ladies and gentlemen, I've just introduced this concept of consolidation using a short illustration. Later on, I will be looking at situations where we have associates, joint arrangements, even with more transactions, for example, where we have the consolidated income statement, where we have sales between group members. So then if we get unrealized profits on inventory, how do we handle that? So please remember, our training is purely on the basis of giving competencies, key skills to group accountants or to anybody who is aspiring one day to become a group accountant. And the reason why you need to trust us, ladies and gentlemen, just check the kind of brands that are using Aaro's consolidation software, consolidation solution. In Kenya, we have the famous KCB. You can see here, KCB. We have I&M Bank. We have Equity, Kenya Women Finance. Ladies and gentlemen, we have AAR. We have the famous East African breweries. These are just but a few companies locally here that are using Aaro's group consolidation tool, And then, of course, globally, there are brands, of course, you guys must be knowing. We have the Sony. We have Komatsu. We have AAK. These are big brands globally. And as you will be realizing, Aaro has got presence in 140 countries. Ladies and gentlemen, if you are serving these kind of brands, what do you think of our academy, which trains group accountants? Once you have our certification that you have trained with us, we strongly believe that one day you will land great jobs in either one of these institutions or institutions which are coming up group-wise. It has been a pleasure hosting you, and I believe you will go outside there speaking something nice about Aaro software, consolidation software, consolidation tool, stroke Aaro Academy. For more information regarding Aaro, get to our website. Simply Google Aaro and you'll be able to get us. Thank you very much. We look forward to training you. Be blessed.